Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to recap Jobs Week, including the jobs report we got on Friday and what it all means for mortgage rates. Logan, welcome back to the podcast.
It is wonderful to be here from lovely, cold, but not snowy Utah.
Yeah, we're in Salt Lake City for the Intercap Lending event, which you spoke at, and I got to do a really fun moderation between you and Josh Romney, and that was really fun. We're going to actually try to recreate some of that in a podcast next week, so people stay tuned. It's going to be good.
Yes, and Mr. Romney actually got me a Gandalf doll and presented to me on stage. So
he did. It's this figurine. It was awesome. So yeah, he's a big fan. We're a big fan of them. So okay, our topic today: jobs. This has been Jobs Week. Then we got the jobs report. So what do we know?
Okay, so let's go back in time to when the 10-year yield was at 380. Okay, and mortgage rates were down to 6%. And we talked about the Hodor line that, this level, to get underneath here, you're really going to need some economic weakness. And we had 3 negative jobs reports that week. Bond yields got all the way down to like 362, and then the economic data started to get better. And then from that time, the 10-year yield has gotten all the way up. And the 2025 forecast, 7.25 mortgage rates, 10-year yield 470. Currently, right now, we're at 474. So now we're on the reverse side, and this is why we do channels, right? This is why we do not mortgage rate target. We channel the cycle data and try to work off of the economic data, because if it gets better or if it gets worse, the 10-year yield and mortgage rates move with that. This jobs week, job openings, fine on the headline. The internals were soft. ADP, not that important. Jobless claims fell again, right? That's the key data line. And now jobs week. Jobs day, Jobs Friday came. 256,000 headline print. Wage growth ticked down just a little bit. But when I look at everything for 2024 now, the last 6 months and 3 months together averaged out, it's at the high end of my 2024 forecast, right? So just to explain to everybody, we had a COVID-19 recovery model, April 7th, 2020. We retired it on December 9th, 2020. Then we went to the labor market recovery model. We said all the jobs will get back by September of 2022. I think we're a month earlier than that. Then by the time we get past 157 million, labor data should cool down. December of 2023, we're over 157 million. So this year, 2024, job growth should slow down to 140 and 165,000 per month. That would look normal to me. That's kind of where we're at on the higher end of that. So the labor market's getting softer. Manufacturing ended up the year negative 87,000 jobs. Higher rates are doing their thing in terms of keeping hires at a certain level, but it's not breaking. And when it's not breaking, this is what happens, right? The Federal Reserve and bond market, everything, if the labor data was actually breaking and jobless claims were heading toward 300, then, you can get rates to fall down. But when the Fed went hawkish again, and the labor data is still beating estimates, it really depends on what everybody thinks about where they think job growth is. And to me, it looks normal right here. We see weakness in manufacturing. Residential construction job isn't creating a lot, but it's not declining yet. And now we get into this whole new paradigm for 2025.
If you're in mortgage, I think you woke up this morning, saw the jobs numbers, and were like, oh, gosh, come on, can we not get a break? Because we all know job, coming in as a beat means mortgage rates go up, right?
The biggest break the mortgage and real estate industry got is spreads are getting better. And I will, pound this fist down. We would be at 8% mortgage rates today, okay, if the spreads didn't improve. So the volatility is compressing itself. The yield curve is uninverted. This is how kind of economic cycles work. But in this regard, the economic data was getting better. Now, I know some people say, well, Japan and the UK, their economy isn't great. Why are their yields? China's 10-year yield has collapsed because of their economic weakness. But if you look at it where the Fed funds rate is, where the 10-year yields, where inflation is, it looks about right. in that context, if you believe that the labor market is more important than inflation, and that's always been the call since the end of 2022, I'm going to stick with that till the very end of the cycle. And the labor market is getting softer. It's just not breaking. I think that's the frustrating part for a lot of people. Breaking means jobless claims head toward 323,000. Breaking means job growth is below trend. For a while there, it looked like job growth was going below trend. For a while there, jobless, and all that reversed. And that's why we show those charts, not only in the labor data reports that we write every Friday, but we also show that on the weekly tracker now with jobless claims. So everybody can kind of get on the same page of where rates are.
So when you say, labor is weakening, weakening, softening, but it's not breaking. How does a stronger than expected jobs report say that it's weakening or softening?
Because job growth was much stronger in 2022 and 2023 than what it was now. And manufacturing actually being negative for the year, which not a lot of people actually know this. Still, I was telling a lot of people, manufacturing's down 87,000. Manufacturing and residential construction jobs together, when they're both declining, is a labor trigger for every recession we've seen post-World War II. So in this context right now, only one is down. And we're not, in a sense, a manufacturing economy, right? We're a consumption-based economy. So when rates get too high and policies too restrictive, or you have a credit event, or let's say oil prices, something like that can bring consumption and growth down low enough to get the economy weaker. But if you look at the second half of 2024, 3% GDP, 3% GDP, Q4 is 2.7%, still above trend. And the Federal Reserve told people that how they look at the economy is through their growth, consumption, GDP models, and they were all good. So they went hawkish, and this, I get it. It's frustrating. It's not how I would operate it, but this is their rules. And the bond market correctly shot it back up. Now, here where we are right now, it's like the Hodor line, except now at this level, you're going to need a lot stronger economic data to warrant yields and rates to go higher from here. Last year, in 2024, when mortgage rates got to 7.5%, with similar 10-year yield, we started to see real weakness in the new home sales sector. We already see housing starts and permits at recessionary levels. This is a current day rate situations. A lot of the data that we've seen are in the past. So does it matriculate itself to now residential construction workers and manufacturing together come down? We'll see if that's going to be, to me, that's the 2025 story. That's why we highlighted. That's why we wrote those articles, because that would be your frontline data line for jobless claims to rise up. So it's a tug of war, but we're kind of at the high end right now of the forecast. It's happened early in the year. We'll see how it goes. Every single economic report, every single week, every single job is really critical at this stage. But the job data fit right into my model, so I can't say that it's weaker. It's at the upper end of the forecast. So for me, it looks right, but for other people, it's different. I constantly see people that keep on saying the labor market's breaking, it's going to, and it just doesn't work that way. It's never worked that way post World War II. So I caution everybody, be careful who you're listening to on the economy, because you see constant recession calls. We're just not there yet. And now we went through all of 2024. And there's always going to be revisions. We always do adjustments, but I highlight that GDP growth and consumption data would not be at these levels if everything was falling apart.
I wanted to highlight a question we got in the Q&A yesterday. And it's actually a question that I hear people ask you all the time. And it's because I think there's a lot of confusion out there, and there's a lot of wondering how much politics and partisanship affects the data. And so let's talk about, can people, we're reporting on the BLS data, we're reporting on these things. How reliable is that data?
It's reliable. It's worked post World War II. There's always revisions in the data. See, the thing is that this is the honest truth. We have a lot of people in the industry that need lower rates, right? It's the third calendar year of the lowest home sales, and only mortgage rates towards 6% gets growth. So I could understand that people say the data's fake, the data's fake, the data's fake. And if you get a bunch of talking heads keep on saying the data's fake, then you start believing in it. Political economic ideological theories are not efficient. Let me give you a great example today. Today, it's Friday. The University of Michigan inflation expectations, which the Fed likes to track, it's at a 1-year high, for inflation expectations. But when you look down in the data, Democrats are skyrocketing in terms of saying that inflation's about to take off and everything, and Republicans are falling down. It's a switch. When Biden was president, Republicans had a lot of inflation expectations and not so much Democrats. We looked at the inflation data in 2018 and 19, and it didn't show breakout inflation, even with the calculated trade war tap dance. So there is no cabal here, right? There is no cabal that are purposely. We always get negative revisions or positive revisions in labor data. And we had bigger negative revisions in 2019. And Trump was president then, and Biden. So I urge everyone to stay away from the data is fake, right? I understand why people want to go there. I understand the frustration about rates, but we are sitting here at the end of 2024. And if job growth was below my trend, then I would say it. But it's right at the top end of the forecast on the 6-month average, so it looks normal to me. And I verify it by the consumption data is holding up. If the labor market is breaking, consumption would go down, growth would go down, and jobless claims would increase. So I urge people, you're going to have to trust the system. The system has worked for decades, and there's no cabal out there that are purposely, tweaking the data lines. You're going to get another wave of revisions, and we just move it off with all the aggregate data together.
I appreciate you walking through that, because I do think the revisions is what throws people, especially like people who don't see this all the time. They're like, how can it be so big? But
This
for
is
you,
why
what you're saying
this
is
is why I
this is
like
the
to show
trend.
this is why I like to show that chart and say, oh my God, did you guys remember the negative revisions in 2018-19 combined? I go, no. I said, look, when people visually see that BLS revision charts going back to decades, they go, whoa. I said, yeah, you get positive revision flows and negative revision flows. But if you take all the economic data together, softening, not breaking, right? Breaking is jobless claims rising, growth falling down, and labor reports coming in lower than expectations. Retail sales, everything, they're just moving along. And I understand the urge, because the frustration for everybody in the industry that, rates are still elevated. The housing market, existing home sales have been in a recession since June 16th, 5:31 p.m. 2022. But you have to be careful of, getting on the herd mentality that the data is all fake, and it's just not the case. You wouldn't have GDP and consumption levels at above trend right now. You can see the higher rate impact manufacturing jobs, 87,000 lost this year. You can see it in housing. Residential jobs have not lost yet. That'll eventually happen. This is how economic cycles work, but be careful with the cabal BLS is lying take.
Okay, so looking at the totality of Jobs Week, you're the Fed. How are you interpreting that? Like, what does this mean for rates going for them doing another rate cut, or even doing, raising rates?
So we actually said this for 2025. If job growth is between 140,000 to 165,000, the Fed is perfectly happy, right? And they'll slowly move down to where they think neutral is, right? So right now, you probably got 2 rate cuts. And again, economic data changes. Last year at this time, when the economic data was beating estimates and then inflation was more sticky, they said, well, we need more confidence. So bond yields went up, housing got hit, labor data's revisions came down. Then we're too tight. It's a moving equilibrium, right? Nothing stays static. But if you look at it, they already cut 1%. They've probably got 2 more rate cuts if everything stays constant, right? But does anything stay constant? No. This is why we track everything. Currencies, the dollar's getting too strong again, all that stuff. So it's a very, very complicated economic cycle. post 2020, I mean, you go from the boringest decade ever in history in the last decade. It was the longest economic and job expansion in history, but it was relatively easy because there was no real big deviation in any of the data lines, to this very, very chaotic 5-year period in the U.S. economy and in housing. And it's more tricky because a lot of old models don't really apply here to this cycle. And you have to just get yourself indulged into the daily data to kind of make sense of it all.
It reminds me, when you think about the last decade, it reminds me of Steve Martin in LA Story. This is an old movie. I don't know if everyone's seen it, but he is a weather forecaster and presenter in Los Angeles, where the weather is basically the same all the time. So he has like these things he throws up, sunny, sunny, sunny. I mean, like it's the most boring job ever, right? And I feel like in some ways, if you look at like the things we talk about now, what would we have talked about if we had had a podcast at the time and you were on twice a week? It's like rates didn't change that much. We didn't have, I mean, things were not happening.
It's interesting because in the last decade, a lot of people knew me as the recession bear killer, right? So we always had people. I'm shocking enough, it was all the anti-central bank people back then. Doom porn creates highlights every single day. Single day we're always coming to the end. So there's always someone to fight. It's like in the movie Gladiator. There was always at least someone to fight. But it was very stable. Like the 10-year yield was in a range. Like all my forecasts, when I started incorporating the 10-year yield, it was like 1.6 to 3%, 3.5%, 4.5% more. That's really it, and you just work off of the internal. So with slower data, you try to find inflection points, but you can't really get big inflection points. But it was such a soft recovery back then that, it really didn't pick up until kind of after 2016. And then, you get a little bit more action. The trade war tap dance was entertaining. But now it's just so wild with some of the data lines. And we're working from ranges with bond yields and mortgage rates that a lot of people have not seen for a very, very long time. So we try to make sense of it all, but again, we just follow the data. We don't care about political ideological theories, right? We just believe that, if let's say job growth was running at 250,000, but retail sales missed 7 months in a row and the economy was growing at 1%, you have to explain why is there such a divergence. But I can't because I'm just following my forecast. It literally came in at the top end of the forecast for the 6-month average. So it looks right to me. But again, everyone has to have their own model. How many people have economic labor models? Not many. So you just be careful of who you listen to, because I constantly see this, this kind of nothing is real, everything is fake and everything. That's not a healthy place to get into when we're talking about economic cycle work.
Okay, so we are, of course, we're about 10 days, especially when this comes out, this podcast comes out, we're about 10 days or less away from the inauguration and a new administration. So we might have some things there. What are you looking at between here and there for economic data?
Well, one of the things is the inflation data becomes a little bit more important in 2025. If the labor data starts to get softer, but inflation stays a little bit more stickier, how does the Fed talk about that? Because to me, it's always about the labor market will override the inflation discussion. And that becomes the next stage of the conversation, I think, because if we start trending below 140,000, then that's, to me, the labor market is getting softer. We already lost jobs in manufacturing. What happens in residential? Elevated rates keep that. And, I had a really good discussion. Somebody told me, does this remind you of the late 1990s, Logan, where the Fed started cutting rates, bond yields, and then all of a sudden they started raising rates again? And they were everything's fine, everything. And then all of a sudden, residential construction workers lose their jobs and they totally ignore that. Then all of a sudden, something happens where the economy goes into recession. If mortgage rates, if the spreads didn't get better, we're at 8% rates. I'm already talking about at what point does the residential construction workers follow the manufacturing, and that draws down the total payroll growth The one aspect about 2025, if you want to put political economic theory into this, does the Trump administration follow through with its firing of government workers? Okay? Because if
Right.
you fire the government workers, then my job data goes below trend, right? So that's something to think about. I don't know. Obviously, Elon Musk said they probably can't find $2 trillion of things to cut, which wasn't a real number to use anyway. But that is something that is a policy talked about. I don't know if they follow through with it, but if you take government jobs out of the equation, then my total job number comes down anyway, right? So if there are layoffs, then the unemployment rate goes up, job growth slows down. We'll take it from there. But the private payroll growth has slowed down, and we've seen the slowdown in manufacturing, which started the year off higher and now is down 87,000.
So I know we've talked before about how hurricanes can impact different economic data. We're having fires. I don't. No one knows how much is going to burn or what's going to happen. Is it the same with fires as it is with hurricanes, as far as you can see it in the economic data?
So right before I came on this podcast, somebody asked me, well, we have 5,000 structures burnt down. Some of these homes didn't have insurance. What's the economic impact? Usually what happens is the government comes in, FEMA comes in and gives money out. And then all of a sudden, construction workers are needed because you got to start rebuilding those homes. Or you don't need to rebuild those homes. You rebuild those homes in a different way that are more fire resistant. Whatever it is, disasters are, in a sense, stimulus packages. It's a horrible way to say it,
Right.
but that typically is the case because the government steps in, and they have to rebuild. So construction residential workers can be in play just for Southern California, of course, in that light. Of course, hurricanes, when they destroy, same thing, right? If people want to rebuild and move, they need workers. You need more lumber. You need, stuff like that. So that's how I view. If you had a disaster and there was no federal government help and the state local money wasn't there and insurance wasn't, that's a whole different story. You got people losing their homes and, but usually what happens is the government steps in and provides relief in natural disaster areas.
So we will look at that going forward, as we talk in the coming months, if we see some of that stimulus, quote unquote, stimulus coming through.
It's just in the housing market, like we've talked about. I think when I did that Yahoo Finance interview early 2024, are some parts in the U.S. livable? And we have to have an uncomfortable discussion that you either build homes that are fire resistant, water resistant, or, like what FEMA told Florida, we're not going to give any more money unless you build away from these water prone damages, so the cost of insurance goes up.
Right.
I don't know if this is the exact figure that's correct, but I got this number yesterday. There's like $400 million left in the California Insurance Fund. Okay, so the first initial estimates for the damages is $52 to $57 billion.
Wow. Because those are some really expensive homes and properties, right?
As somebody like myself, I grew up in Santa Monica. I spent a lot of my summers as a kid in Pacific Palisades, going to summer camp, basketball camp. So that was kind of the area that I grew up in. They were expensive homes, and obviously this impacts the entire insurance thing, right? So eventually, as a country, federal government, the states, the private sector has to figure out a way, because this is happening more and more.
Right.
Right. This is happening. Do we need to take all power lines and put them underneath the ground? Is that something? But we seem to not want to really engage this situation, because I think it's an uncomfortable alliance between the state, federal, and the private sector that nobody wants to take that let's team up and think of a plan. So it's something to think about. And that's why in that interview, I said just some parts in the US might not be livable. And if you can't get insurance in some parts, it's not a functioning housing market. You can't get a loan, and being self-insured or not, not having insurance in a fire zone or a hurricane zone is not practical. So hopefully, we take steps into creating a plan for this, but so far, not much really done in big scale terms. So
for listeners who want more information, I did have CoreLogic's disaster director of disaster response, something like that, on the podcast. And so go back and listen to that. That actually came out on Friday, January 10th. This podcast is coming out on Monday. So we kind of delve into what that looks like. But Logan, thank you so much for being on. Thank you for walking us through Jobs Week. It's a big one. And I know that, for someone like yourself who follows data, it's just been like this very exciting week. I don't know if anybody else gets as excited about Jobs Week as you do.
No, this is why everyone needs one nerdy friend.
Yes.
And again, when I talk about labor data, a lot of people say they'll accuse me, you're very pro-America. So, okay, listen, if the data was getting weaker, I go with it. If the data got stronger, I go with it. If the data looks normal to me, per my forecast, I can't say that it's weaker underneath trend. So this is why the paper, rock, scissors, labor over inflation. The Fed's not going to really pivot until the labor market breaks. So if you want lower rates for longer, you need to see that. And the key data lines that we highlight were getting better the last few months. And it's just the Fed says that. I think when Jerome Powell, I think a lot of people forgot this. Jerome Powell came on TV and said, well, we follow jobless claims and they'd be going lower. Well, jobless claims after that had been going higher and then it went lower again. So everyone's kind of moving off of what it is. But now that we're up here, like I don't have a Hodor or a Gandalf line on the top end until jobless claims break. Like what I said if jobless claims are heading toward 323,000 4-week moving average, we're not going above 4.25 on the 10-year yield. That's not happening. It just fell. The headline number is almost under 200,000 again. So these things matter for economic cycle work.
Okay, just a note too. You always say paper, rock, scissors, and now you're changing my brain because, of course, that phrase is actually rock, paper, scissors. But because I've heard you say paper, rock, scissors, I wonder how many of our listeners either they go, wait, is that right? Or if now they're like me, if I was going to play that game today, I'd be like paper, rock, scissors. People are like, no, it's rock, paper, scissors. But see, you're influencing us even on this topic.
Did you really have to go pick on that thing now?
Absolutely. I'm going to pick on all of the things.
By the way, wherever we go on the nerd tour, everyone comes to Sarah and goes, thank you, Sarah, for doing the Lord's work in trying to contain this man. And we know it's a lot of, hard stuff. So we actually had a very fun discussion on stage with Josh Romney and myself. So again, talking it out, talking about data, being nerdy, it's a positive thing, but our job is to make sense of everything. And I just thought if people could remember the key phrase for my work with the mortgage rates and labor is that the Federal Reserve is going to keep policy as restrictive as possible as they can until the labor data starts to crack. And we give cracking data lines to follow. They're not quite there yet. So.
All right. We will be standing by. I know that you're checking things all the time. Logan, thanks for being on. And this week starts you being on 3 times a week. So normally you're on Monday and Thursday. We are going to change everybody. Everybody needs to adjust. It's now Monday, Wednesday, Friday.
Yes. Chart Daddy 3 times a week. And also, everywhere we go, they're giving Chart Daddy gear. So we're going to have to see who actually provides the best Chart Daddy merch out there.
It's so awesome. Okay, we'll talk to you again very soon. Thanks again.